There's no escaping the significance of financial technology in the world of fund management. Fintechs becoming the most influential tool for investing, analysing and operating capital funds around the globe. But with influence comes responsibility. I'm Andrew Wilson and I'm here in Davos to talk to Francesco Filia, CEO of asset manager Fasanara Capital, about the future of financial governance as the big banks recede from the marketplace. Francesco, great to have you here, great to talk to you. Before we go into the details of the Fasanara platform itself, give us an idea about the world of fintech.
Sure, Andrew. So fintech is all of that system of players which are trying to substitute or work in tandem with the traditional banks at offering financial services to both consumers and small and medium enterprises across the globe. It is an emergent new trend which has really lasted for the last 10 to 15 years in Europe and in the US and really now scattered across globally. It tries to make an improvement to the user experience that consumers and corporates have or are going through as they try to get lending done. So the type of fintech that we typically look at is a fintech lending. So it's all these new types of lending which are very categorized by specific types, and the user experience is way better, the execution is way faster than the traditional banks can offer. It goes from invoice discounting, SME financing, supply chain financing, revenue-based financing, SaaS e-commerce financing, down to consumers, which can be point-of-sale financing, buy now, pay later, credit cards, consumer loans, all the way into like the subscription economy and subscription-based type of financing, like car financing, home financing, tech rental financing, and so on and so forth. The basic idea behind it is that as opposed to be an omnibus provider of financial services like the traditional banks typically are, you try to focus on a specific vertical and you specialize in it to the point where the service is unbeatable and much superior to the one that the banks were used to offer. At that point, the customer adoption is entrenched and rises and compounds, and the market penetration grows year into year. And now we are at year number 10 to 15, depending on which country you're looking at, of this emerging trend of fintech.
So where does Fasanara fit into all this?
Fasanara is this incubator of fintech platforms globally, channeling 4 billion, roughly, which is our assets under management at this moment, into the real economy through this web of 125 plus fintech platforms doing fintech lending. The capital comes from large institutional clients, which has been entrusting Fasanara with mandates of big amounts. And so these institutional clients are the likes of pension funds, insurance companies, some of the largest in Europe, in North America, and endowments, foundations as well. So the idea is that we facilitate the investment of these large institutions into the real economy through fintech technology. And the end result for these institutional accounts is that they can enjoy fixed income type of portfolios, which are with a very small volatility and very little, if no negative months in terms of performance. Very granular portfolio, which means highly diversified with millions of loans within each, and with a very short duration, which is like 3 months on average. And a yield which is commensurate to the risk they take, and actually much higher than the risk they take, because the yield of the funds can be anywhere between 5 and 15%. So the institutional accounts, they get a good place to park their larger capital. And this is already a great endeavor, because if you think about it, the large capital pool is institutional account. It is more than $100 trillion globally. So it is literally the elephant in the room. And in recent years, they've been living with very little alternatives because bonds were yielding zero or negative, and equity was very expensive and ultra volatile. So to provide them with this alternative asset class is great for them because it allows them to have a stable income generation, which is what they really desperately need. At the same time, on the other side of things, the money gets through immediately the real economy into real SMEs, which are underbanked or unbanked completely, and into financially excluded consumers. So it serves a very big, raison d'etre for the real economy itself. Disintermediating traditional banks are doing that because traditional banks have done less and less of that over the years. They've been focusing on large corporate clients and leaving behind these SMEs and these type of consumers. So there is a very strong impact of the type of use of funds that is out there. And there is a very strong feeling the needs of those institutional accounts that they need to deploy those amount of capital. One last point is that all of these SMEs are in need of funding because they're left behind by traditional banks. And let's not forget that in a number of countries out there, in particular in Europe, 90 to 96% of GDP formation depends on these SMEs, and 90 to 96% of employment depends on these SMEs. So as you help these SMEs, you help really the real economy where it really matters. And you don't do some self-referential trading on bonds in the liquid markets, which there is enough of it already.
So we've had banks for hundreds, thousands of years, and that's always been the model that people have thought of. The bank is the center of the clearance of the capital, the holding and the moving. What you're suggesting, what fintech does, clearly is disruptive, but actually could be extremely disruptive going down the line.
Absolutely, and I wouldn't want the message to be that this is in complete competition to banks. I mean, this can coexist with the traditional banking channels, and as a matter of fact, there are banks out there which are very innovative and they're looking at the fintech as an answer, not as an enemy. So there are a lot of partnerships going through between fintechs and banks, but it is a reality that the traditional banks are in need of a profound overhaul, not differently from what is needed in the asset management industry, but also not differently than what is happening in transportation, in e-commerce, in consumer, in retail, etc., in utilities, across the board, really. So the wave of technology is kind of inescapable, and it's affecting also the traditional banks. Traditional banks, they suffer from two main weaknesses. One is the regulatory, perhaps overdrive, let's call it. So they need to have a lot of regulatory capital requirements set aside, which has curtailed their ability to lend to certain sectors and cohorts of the real economy, for example, SMEs. But this is almost sometimes an excuse for the second really weakness that banks have, traditional commercial banks, which is the lack of technology and the inability to do the proper IT upgrade. Some of the reasons why banks have been unable to equip themselves with the proper technology has got really to do with a lack of drive to achieve that. And some of it is due to the fact that they're still very profitable. And for all the talks about the declining businesses in banks, they're still doing very good money. And so they are kind of sitting on their laurels. And they don't feel really the need to completely transform their system. The risks are too high, and the outcome is too uncertain. And that's why this innovation is left really to the innovators, to the disruptors, to the early adopters, companies such as ourselves.
How are the lives of my children going to change when they start to need advice and interaction in their financial affairs? Looking ahead, how do you think the world of finance is going to transform?
Well, I think our kids are going to find a hard time accepting some of the difficulties of having to deal with a traditional bank. Like me and you, we can go to the bank branch, accept a certain lead time to the services being rendered. Our kids probably won't have the same level of patience in the digital age. They're used to have everything immediately and like a mobile-based, cloud-based, in very digital performance already. So like their life is going to improve from the viewpoint of having to spend less to achieve the same. And probably they will also be able to achieve more by having more time available to spend on more productive endeavors. Banks are going to eventually decide to compete as they decline in relevance, right, in this market. But chances are that that is going to be too late by the time they really tackle this properly and enforce.
One last thought then, it just occurs to me as a layman on these issues, that trust is going to be extremely important for all this to work going down the line.
It is, and I'm not going to be an advocate of the trustless way of building up things, connected to the blockchain philosophy. I think a centralized entity can be trusted. Obviously, there are endless examples of failures, like FTX most recently, Enron, before, and so many others in between. However, I think that trust can be built by continuous service of a certain the highest standards over a prolonged period of time. Like the idea is that this fintech can be an alternative channel to channel money and capital through through technology to the real economy, as an alternative to the traditional banking channel, and therefore making less severe the impact of a credit crunch, for example.
Francesco, thanks very much indeed.
Thank you.